Hey, welcome back. It's Jason Walter here. In today's video, I have a lot of housing market updates to share with you today, including home prices in the United States, how those have fluctuated since this pandemic has started, including mortgage rates and changes to mortgage loan forbearance rates as well. In addition, I have some information to share with you regarding commercial and multifamily delinquency rates and much, much more. And if you're new here, welcome. I post videos about how this pandemic is affecting our real estate market, as well as personal finance topics. So that's something you're interested in, I invite you to subscribe to this channel. Also, please hit the like button if you appreciate real estate market updates, just like this one. For today's video, I'm going to share my screen with you, so let's go ahead and dive right into the video, and I'm really excited to share this information with you. Okay, the first thing I want to share with you today is a report by Black Knight. And Black Knight's really great because they run a lot of data or provide a lot of data in the real estate and mortgage industry. So they have a report here about how home prices have changed during this pandemic. And this headline at the top here really says it all. It says, despite the current economic uncertainty, home prices continue to soar nationwide. They also say here that the annual percentage change in the overall median existing single-family home price, this is existing homes, not new houses. They're saying that existing houses have skyrocketed in the past several months, with recent numbers at 3 to 5 times those rates that we saw in the past several years. So quite remarkable. So there's giving 3 main reasons about why we're seeing increasing home prices. And of course, if you follow my channel, you've seen a lot of my videos that really mention these reasons as well. So number 1, inventory. I just posted a video 2 days ago about this, about why this is an issue. We have low inventory across the nation and also in Sacramento, where I work as a real estate agent. So on a national level, the most recent stats we have is that the inventory is down about 19% compared to 1 year ago. We'll have some new stats for you in a couple weeks for September stats nationwide. And in Sacramento, where I live and work, the inventory is down about 55% compared to 1 year ago. And 1 year ago, we also had low inventory levels. So I think it's been going down past several years. And that's basically what Black Knight is saying as well. They said have low inventory over the past several years, and it's been compounded by the fact that we have more Americans moving because of this pandemic and people working from home, for example. Another reason for the increasing of home prices, according to Black Knight, is an appetite for more space. Work and school arrangements are becoming more and more remote and working from home and also doing school from home. So what I'm finding is that a lot of people, especially live in high-priced areas where they're allowed to work from home and their kids are going to be doing school remotely, then why not move to a more affordable area like Sacramento and other parts of the country and state where they can buy a house that's bigger and also a bigger backyard because they're going to be spending more time at home. Hope that makes sense. They also say that this has created a higher demand for larger homes with spare room for office space. Of course, also a backyard too, especially if you have kids. Another reason that they state for the high home prices or increasing home prices is the low interest rates. I talk over and over again on my channel about how we have record low interest rates right now, or near record low, less than 3%. And I'll go over that here in just a little bit. So they have a really great graph here. I want to share this with you. This is the annual percentage change in the overall median single-family home price across the U.S. market. This is for existing houses. This figure has shot up since July, and it says now we are more than 14% higher than 1 year ago. So here is a great chart here. It's from beginning of January 2001 through July of this year, 2020. So you can see here we had the shot up where we had the bubble in the Great Recession that occurred here in late 2006, 2007 when we had the peak home prices, and then we had the dip, of course, everyone knows about, and then the change in the real estate market, rebound in the real estate market ever since about 2009, 2010. And you can see that here, especially in 2012. 2012 was a time when Blackstone and Waypoint Homes were buying houses left and right, thousands of houses, renting them out and getting them back on the market. So we saw this huge uptick during this time. And then now, again, this is January, the home prices have absolutely just shot through the roof. It went down the first 2 quarters of the 2020, especially the second quarter. But ever since July, home prices have been absolutely skyrocketing. They also have a really great graph here as well I want to share with you because they're saying that we're seeing home prices increase in many markets across the United States. It's not just one market like the Bay Area that's increasing, it's in many markets across the United States. So there have, it says here, as seen below, the overall high appreciation rates in home values has been broadly based. So you can see here they show San Diego County, Los Angeles, Sacramento, Miami-Dade, Dallas, Houston, Atlanta, Boston, Charlotte, Seattle, Vegas, Chicago, Minneapolis, Connecticut, Cleveland, and St. Louis. So all across the country in some major markets. But it was really, and this is kind of messy, there's so many data points here, it would have been better if they kind of blew this up. But you can see that every single one of these markets here had an uptick ever since Q2. So Q3 really had an uptick. Every single market here all went up. So it's pretty remarkable that it's not just in one market. We're seeing this on a broad level. All right, so let me share, of course, with you mortgage interest rates. So Freddie Mac just reported just today that the mortgage interest rates for a 30-year fixed rate mortgage averaged 2.87%. It's crazy low rates. I actually just refinanced my mortgage and I got a 2.625% interest rate, which is absolutely insane. I never thought I would ever see interest rates this low. And by the way, if you want a referral of a loan officer in California, if you live in California, just leave me a comment below and I'd be happy to share a couple of referrals for you. No financial gain whatsoever, just want to help you guys out. All right, so then the Freddie Mac's chief economist stated the following. He said that rates have flattened over the last month. This is because we've seen rates at less than 3% ever since July. Quite remarkable. He had a great quote here too I want to share with you. He says, but with record low rates, buyer demand remains robust with strong first-time home buyers coming to the market. I'm really seeing this as well because people live in San Francisco, for example, where half of the businesses are closed right now. A lot of people are giving work at home arrangements or giving the green light to do that. And if they move, some of these companies are saying, if you move within 100 miles, we'll still pay you the same. So they can move to Sacramento, which is around 99 miles from the Bay Area, and still get paid minimum or still get paid Bay Area wages. And then oftentimes their housing payment goes down. They're able to buy a bigger house, the bigger yard. So it really makes sense for a lot of people to move. In addition, they say the demand is particularly strong in more affordable regions in the country, such as the Midwest. We talked about that just a little bit ago. They say where home prices are accelerating at the highest rate in over 2 decades. Obviously, because the people with work at home arrangements are able to do this and take advantage of living areas where they can really save a lot of money. So the 30-year fixed rate mortgage averaged 2.87%, like we said, but 1 year ago that was 3.57%. For a 15-year fixed rate mortgage, it is actually 2.37%. I don't know why anyone would want to get a 15-year mortgage. Depends on your situation, I suppose, but I don't see why you'd want to, in a rush, to pay off a mortgage if you can get a rate of less than 3%. Because one would assume you could save that money and invest it and earn a better rate than 3%. Hope that makes sense. 15-year rate mortgage is 2.37%, and one at this time of year, last year, it was 3.05%. All right, let's talk about mortgage credit availability because that decreased in September. And this is through the Mortgage Bankers Association or the MBA. Talk about the MBA all the time on my YouTube channel here. But they're saying that mortgage credit availability decreased in September according to the Mortgage Credit Availability Index or the MCAI. They said the MCAI fell by 1.9% in September. They say a decline in this index indicates that lending standards are tightening. We talked about this in my previous video from 2 days ago again. Some companies like Chase and Wells Fargo, or is it Bank of America and Wells Fargo, one of the two, is not allowing or not accepting HELOCs, for example, home equity line of credits. So they're saying that the mortgage credit supply decreased in September to its lowest level in February 2014 due to these tightening of mortgage standards or mortgage loan standards. And it says across all loan types, there continues to be fewer low credit score and high loan to value loan programs. So they're saying that there's less programs for those who are less qualified. So the people right now who are really getting mortgages are really more of those people that are really well qualified, people that have high credit scores and have low loan to value scenarios. And it says the housing market is overall on a strong footing, but the data show that lenders are being cautious given the spike in mortgage delinquency rates. We all know that due to mortgage loan forbearances that people could enter into as of late March of this year. And then the second quarter, as well as the ongoing economic uncertainty, of course. And they have a great graphic here that shows, it's really hard to read it, but this is really basically from 2011 to now. And you see that this is the index. So an increasing of the index means that they have a loosening of standards, of underwriting standards for new mortgages. And then a decrease means that they're having a more tightened standards in order to get a loan. I mean, it's a little bit more stringent guidelines in order to get a mortgage. And you see this fell off the cliff this year where it became much more stringent to get a loan. So that's quite interesting. I want to share that with you today. All right, let's go over mortgage applications. So mortgage applications increased in its latest MBA survey. Again, the Mortgage Bankers Association. No big shocker here. We have near record low interest rates. Of course, that's going to cause an increase in mortgage applications, both on the purchase level as well as on the refinance level. So they're saying that the mortgage applications increased 4.6% from 1 week earlier. And the index increased 8% from the previous week and this is the refinance index, increased 8% from the previous week and was 50% higher than the same week 1 year ago. Quite remarkable that we have their index is increasing by 50%. No big surprise since rates are about 0.75 points less than 1 year ago. And it says here that mortgage rates declined across the board last week, with most falling to near record lows, and borrowers responded. The refinance index jumped 8% and it hit its highest level since mid-August. It says the purchase market is growing at a strong clip as well, with activity last week up 21% from a year ago. So not only are refinances really increasing, but purchase activity is as well. And check out my previous videos about how home prices and home sales have fluctuated during this pandemic. They also said the average loan size is also at a new record of $371,500. It says as the higher loan size categories continues to lead the growth, whereas the people who are getting loans with lesser amounts are not in the market as much as people who are buying houses that are bigger and more expensive. It says here just that. There are signs that demand is waning in the entry-level portion of the market because of supply and affordability hurdles. I mentioned this before as well, is that we have these increasing home prices and some people are going to be left behind because they're going to find out that they're going to be able to afford less and less for a house, and they might have to sit and wait. We'll have to see. As a result, the lowest price tiers are seeing slower growth, which is contributing to the rising trend in average loan balances. So the California Association of Realtors, they actually posted maybe about 3 weeks ago, and it was really interesting to see that the sales of houses of $2 million and $3 million plus absolutely skyrocketed over the past few months. And that is really contributing to record home prices in California, which is for the first time has reached over $700,000. And I'll try to give some information for you on September stats in the next couple of weeks regarding that as well. It says that the refinance share of mortgage activity increased to 65% of total applications. So obviously more people are refinancing compared to purchases, but there's still a strong amount of people who are actually doing purchase applications as well. In addition, the adjustable rate mortgage, or the ARMs, share of activity remained unchanged at 2.2% of total applications. This is obviously a great thing because the ARMs have a very short period where the rate is fixed. It could be 5, 7, 10 years. And then thereafter, the rate can fluctuate when the interest rate fluctuates. So if interest rates increase, so does their payment. So it's definitely a more risky loan program. So it's great to see that's only 2.2%, whereas back in the Great Recession, I would say that probably the vast majority of the loans out there probably were ARMs, and we had a market or environment where interest rates were increasing, and so people's rates or their payments went up quite a bit. In addition, during the Great Recession, people had interest-only loans, and so that caused it to be even further aggravated there. All right, so that is the mortgage applications. Let's go over the share of loans in forbearance, because that declined to 6.81% from 6.87% in this most recent report from the MBA. And they're saying that 3.4 million homeowners are still in forbearance right now. And if you recall, because of the CARES Act that was passed in late March, people could enter into a mortgage loan forbearance for 6 months and then potentially get another 6-month extension. So these people in forbearance, really, I don't see this going down very much until we reach about March or April of next year. And then there's a whole bunch of options, especially if you have a mortgage that's backed by Fannie Mae, Freddie Mac, FHA, VA. There's a lot of options for people out there. If you are in mortgage loan forbearance and you want to know your options, definitely go to knowyouroptions.com. It's a great resource for you. It basically stipulates all the options you have when you want to exit a mortgage loan forbearance. And that definitely is not to pay a balloon payment of all missed payments. You can do a loan modification, payment deferral. You can take all of your missed payments on the back end of the loan. There's a bunch of options for you, but check that out. All right, so the share of Fannie Mae and Freddie Mac loans in forbearance dropped for the 17th week in a row to 4.39%. These are loans backed by Fannie Mae and Freddie Mac, 4.39%. However, Ginnie Mae loans in forbearance, these would be like VA loans, for example, and FHA loans, which have a low minimum down payment of 0% or 3.5%. Those increased 1 basis point to 9.16%. So those loans that have a low minimum down payment, you're seeing a much higher incidence of those who are in forbearance compared to Freddie Mac and Fannie Mae, about double. So that's a little bit concerning. We'll have to see how this changes. It didn't change much last week, so we'll have to see in the next few weeks and few months to see if this continues to increase or if these numbers are going to be going down. We will see. So the MBA Senior Vice President and Chief Economist stated the following: the significant churn in the labor market now with more than 6 months into the pandemic is still causing financial distress for millions of homeowners. As a result, more than 70% of loans in forbearance are now in an extension. So that 6 months extension. If you recall, you can start your mortgage loan forbearance in March. So right now we're seeing that 6 month period expire, and so people are taking that 6 month extension. So also related to this, because they're saying that the labor market is really hurting, is the unemployment rate. So I really want to point this out because some people may not be aware of this. In January and February of this year, let's just say February, our unemployment rate in the US was 3.5%. We reached 14.7% in April, and then it has decreased ever since then. So May 13%, then 11, 10, 8, and now we have decreased again in September to 7.9%. So it's great to see this downward trend. However, this number is about double what we saw in February. So the jobs are really not coming back to what we were during pre-pandemic levels. All right, let's talk about this last but not least. And this is commercial and multifamily delinquency rates and the MBA. Once again, they have a ton of information they shared past few days. They actually said the delinquencies have decreased in September. So this is really interesting. They actually break down total delinquencies, but also by the different property types or loan types as well. So the share of commercial and multifamily loan balances that were current increased in September, rising to 94.3%. From 93.6% in August, with fewer new loans becoming delinquent. So 94% are current on their loans for commercial and multifamily, which is great to see because that means that only or less than 6% are delinquent, right? They also said that the delinquency rates continue to be elevated in the lodging and retail sectors. Obviously, lodging and retail are getting absolutely hammered this year, especially when this pandemic hit. So really remarkable here. So 22.1% of the balance of lodging loans were delinquent, and that was down from 23.5% in August. And then for retail loans, 13% are delinquent. However, when you compare that by other property types, they have declined quite a bit. So you look at healthcare, industrial, office, and multifamily loan balances are all down quite a bit compared to the lodging and retail space. So again, lodging 22%. However, healthcare is only 4.4, industrial 2.7, office 2.1, and then multifamily 1.7. So healthcare is about 5 times less than what we're seeing for the lodging loans. So it's quite pretty remarkable there. They also say the volume of borrower inquiries, again, this is for commercial and multifamily, the borrower inquiries and requests continued to fall in September. I hope you enjoyed watching this video. If you did, please hit the like button. I greatly appreciate that. And also, if you haven't subscribed already, please do and join the family, and I'll keep you updated with new developments. Also, don't forget, if you want 2 free stocks, then click on the link below, because for a limited time, WeBull is giving away 2 free stocks, with each of those being valued up to $1,600 each when you deposit $100 within 30 days of signing up. And that's running for a limited time. The current promotion ends on October 15th. Hope you have an awesome day and look forward to seeing you on the next video.